So, hello guys, my name is Gagandeep Singh, and I am a qualified chartered accountant with more than 22 years of experience of working in different industries, different domains, and at different positions. So, over the years, I spent in the industry, I have experienced that I am having interest in the areas of taxation, including international taxation. So I thought to help my CA professionals fraternity and CA students by explaining them the concepts of taxation. So I'm starting here a series of concepts of international taxation first, and I will be recording the videos covering 10 concepts in each of the upcoming videos, and I'll try to cover all the concepts for your understanding. So welcome you all to this new series of international taxation, which is fully based on the new Income Tax Act 2025 as amended by the Finance Act 2026 and also the new Income Tax Rules 2026. So as you know that the income tax comes into force from 1st of April 2026 and represents a comprehensive rewrite of the entire Income Tax Act 1961 with a clear focus on simplification and better structure. So in this first video, we are going to look at the foundations of international taxation under the new law. We will understand how India taxes cross-border income, how residential status interacts with the source-based rules, and how double taxation is relieved through the treaty benefits and the foreign tax credit. In the upcoming videos, we will go into more deeper concepts. For example, permanent establishment, attribution of profits, specific treaty articles, and practical planning examples. So here we have our first slide, which talks about what is international taxation. So let's start with the most basic question: what exactly is international taxation? So, guys, international taxation essentially deals with, how income is taxed when more than one country has a nexus with that particular income, either because the taxpayer is a resident there or because the income is sourced there. So, under the Income Tax Act 2025, India continues to apply a combination of residence based rules and the source based taxation. And the act is structured to clearly set out when income is received, when income accrues, or when income basically deemed to accrue or rise in India. So in practical terms, international taxation comes into play whenever an Indian resident earns foreign source income, number one, whenever a non-resident earns Indian source income, number two, and the last one is, if the same income can potentially be taxed in both the jurisdiction, I mean, the Indian jurisdiction as well as the foreign jurisdiction. In that case, it requires, double taxation relief, which are being provided here as per the sections 159 and 160 of the new Income Tax Act, and also, of course, through the double taxation avoidance agreements. For example, if an Indian resident professional provides online consultancy services to a European client, so we are talking about the examples which is there in the right side of this slide. So here, if an Indian resident professional basically provides online consultancy services to a foreign client and is paid in foreign currency, India is having taxing rights based primarily on residence, while that foreign country, I mean the European client basically, he may look at the source income or the source or the withholding rules. The role of international taxation provisions and of the treaties is basically to allocate taxing rights and then ensure that the same income should not be taxed twice in an unfair manner. So this is basically the meaning of international taxation in a summarized manner. If we go to the next concept, which is residence in India, as per section 6 of the Income Tax Act 2025. So international taxation always starts with residential status. So this is the fundamental principles of international taxation. Section 6 of the new act lays down the test, basically, or the conditions for when a person is treated as a resident in India, and also recognizes a subcategory of not ordinarily resident, similar to the erstwhile Act 1961. For individuals, the familiar number of days test continue in substance, with the specific relaxations and clarifications. For example, there are special rules in the income tax rules 2026 for computing the period of stay in India for crew members of foreign bound ships. If we talk about the companies and other entities, residence is generally linked to a place of incorporation or the location of effective management, broadly aligning with the international practice. So why is the residence concept important for international tax? This is because residents are typically taxed on their worldwide income, subject to definitely exclusions and the treaty benefits, whereas the non-residents are only taxed on income received in India or deemed to accrue or arise in India. If you take a small example which is there in the right side of the slide, here, if an individual is resident in India for a particular tax year but works part of the year in Dubai, let's say, salary for services rendered abroad can still be taxable in India on a residence basis, unless there is a specific exemption rules or specific treaty benefits are there. If the same person were non-resident, basically, in that case, only Indian source income for services rendered in India would be taxed. So this is the concept of international taxation, specifically related to the residents in India. Okay, if we go to our next concept number 3, which talks about the scope of total income and which are governed by section number 4 and section number 5 of the new act. So here, once we know the residential status, as we discussed above, the next step is to determine the scope of the total income for that particular taxpayer. Section 4 is the charging section. It says that the income tax shall be charged for each tax year at the rates prescribed for that particular tax year. Section 5 then defines the scope of total income for residents, for not ordinarily residents, and of course for non residents. In broad terms, for residents, total income includes income from whatever source derived, which is received or deemed to be received in India, or which accrues or arise or deemed to accrue or arise in India, or even outside India. So this is for residents. If we talk about for non-residents, total income is restricted to income which is received or deemed to be received in India, or income that accrue or arise or deemed to accrue or arise in India. Here the word outside India is missing. This is the difference between the taxability of the total income for residents and the non-residents. So this is where section 9 becomes critical, because section 9 expands what is treated as income deemed to accrue or arise in India. If we see an example here, an Indian resident company, let's say, for exporting IT services to the US, even if it receives payment into an overseas bank account, is basically taxed in India on that particular export income, because it is resident and the business is controlled from India. A non-resident company, in contrast, would not be taxed on such income, if it falls within the scope of Indian source or deemed source rules under section 9, which we will see in the upcoming slide. So this slide basically talked upon the scope of total income for residents and for non-residents. If we go to our next slide, this concept number 4, uh, it talks about income deemed to accrue or arise in India, which is governed by section 9. So section 9 is basically the heart of the source based taxation in India, especially for non-residents. Even if a non-resident has no physical presence in India, section 9 can deem certain categories of income to accrue or arise in India. So key coverage of section 9 includes number 1, income through business connection in India or from any business connection in India, which now explicitly includes significant economic presence, and the dependent agent situations as well. So we will obviously see, the meaning of business connection, the meaning of significant economic presence in the upcoming slides. The next point, so we are here, understanding the coverage of section 9. And first point we have seen. The second point is income from property in India, or I would say the assets in India, or the source of income located in India, and the income from the transfer of capital assets situated in India. And the last one, which is the most important one, is the indirect transfer rules. Where the shares or the interest in a foreign company derive substantial value from the assets located in India. In that case, a transfer outside India can still be treated as giving rise to income deemed to accrue in India, subject to obviously conditions and the carve outs. So here, if we see a small example here, suppose a foreign company, or I would say the foreign holding company, A, holds all the shares of another holding company, which is of course a foreign company B. So in foreign country we have company A, which is the holding company, and we have company B, which is the subsidiary company. Company B in turns, holds valuable immovable property and business assets in India. So if company A sells its shares in company B to a third party, so the new act can deem a portion of the resulting capital gain to accrue or arise in India because the underlying value is substantially derived from the Indian assets. So this ensures that gains on indirect transfers of Indian assets do not escape income tax solely, because the shares are being transferred are of a foreign company. So this is basically the concept of income deemed to accrue or arise in India in a summarized manner. Let's go to our next slide, or I would say the next concept, which talks about the business connection and the significant economic presence. So, the phrase business connection has been historically used in income tax in India to capture situations where non-residents effectively carry on business in India through intermediaries or through separate arrangements. Under the new act, the definition of business connection in section 9 is expanded basically, to explicitly include the concepts of significant economic presence in addition to the classical agency based connections. The explanation clarifies that business connection includes number 1, any business carried out through a person who habitually concludes contracts or plays a principal role, leading to conclusion of the contracts on behalf of the non-residents, covering agency or the commissionerate structures. And the next point here, situations where a person habitually maintains stock in India from which deliveries are made on behalf of the non-resident, or where a person habitually secures orders for the non-residents or a group of related non-residents. So alongside this, the rules prescribed threshold for significant economic presence. For example, based on the amount of revenue generated from transactions with Indian users, or the number of users with whom systematic and continuous business activities are carried out. Think of a foreign digital platform with no physical office in India, but a large and sustained Indian users base and significant sales to Indian customers. Even without a physical presence or physical substance, such a platform may be considered as to have significant economic presence in India once the prescribed threshold are crossed, and the profits attributable to Indian operations can be brought to text, subject to, of course, any applicable double taxation avoidance agreement relief. So, here in this slide, we talked about the business connection and the significant economic presence concepts. Now, concept number 6, special provisions for non-residents and foreign companies. So here, beyond the general rules, the Act also contains a dedicated set of provisions dealing with specific categories of income of non-residents and foreign companies. These are found in Chapter 13, Part E. And the name of that part is basically special provisions relating to non-residents and foreign companies. So some important section in this block includes section 207, which provides for tax on dividends, tax on royalty, and fees for technical services received by foreign companies. Section 208 to section 210, which address tax on income from certain bonds, GDRs, or the securities held by FIIs or non-residents with specified rates and the conditions. And then section 212 to 220, which deals with special provisions for certain non-resident individual and foreign companies, including when return filing uh, may be exempted or may be dispensed with, and how benefits can be claimed in that case. For example, when an Indian company pays royalty to a foreign company for use of technical know-hows, Section 207 specifically prescribes the rate at which such royalty is taxed in the hands of foreign company, subject to more beneficial double taxation avoidance agreement rates. You know, the Indian payer must deduct TDS at applicable rate, and the foreign company may then claim you know, uh, credit, and the foreign company then claim credit in its country of residence under local law, and of course the treaty benefits provisions. So this is the concept of special provisions, on dividends, royalty, FTS, etc. Now coming to our next concept number 7, which is double taxation relief, and this double taxation relief is governed by section 159 and 160. So guys, whenever two countries tax the same income, double taxation double taxation occurs. I repeat, whenever two countries tax the same income, double taxation occurs. The new act deals with through a combination of the bilateral relief provisions and the unilateral relief provisions. Section 169 empowers the government to enter into agreements with foreign countries or the specified territories, for the avoidance of double taxation, and for maybe exchange of information, and assistance in collection of taxes, etc. These are the double taxation avoidance agreements, and they typically allocate taxing rights between India and a treaty partner, or I would say the foreign country, and provide methods to avoid double taxation, such as exemption method or the credit method. So this bilateral treaty concept is being governed by Section 159, and Section 160 provides for unilateral relief, where the same income has been taxed both in India and a foreign country with which India does not have a DTAA, subject to specific conditions. So Section 160 talks about the unilateral relief. If you see an example here, an Indian resident individual who works part of the year in Germany, let's say, and pays tax there on his German source salary, may be able to claim relief in India under the India Germany, DTAA, read with Section 159, usually by way of credit for German tax or the exemption of the foreign source portion, depending on the treaty articles. If if hypothetically there were no double taxation avoidance agreement with that country, let's say for example, so limited unilateral relief could still be available under Section 160, where certain conditions are satisfied. So here in this slide, we have seen the concept of double taxation relief in the form of unilateral agreements or in the form of bilateral reliefs. Let's proceed to our next concept, which is foreign tax credit and documentation. And as per the income tax rules number 75 and 76. So guys, treaties and section 159 and 160 give the conceptual and legal basis for relief, but the methods of how Indian taxpayers actually claim the foreign tax credit are set out in the income tax rules. So rule number 75 specifies the additional documents and the information to be furnished for claiming relief under section 159. For example, details of foreign income, how much foreign tax credit paid, and of course the proof of the tax paid, in the prescribed form. So this is being governed by section 75 and section, or sorry, so this is being governed by rule 75. The rule 76 specifically deals with foreign tax credit, laying down the conditions, computation methodology, form numbers, and the timelines for claiming credit in India for foreign taxes paid on the doubly taxed income. So here, taxpayers are basically expected to maintain the tax deduction or the tax payment certificates from the foreign tax authorities or the payers. Also, a comprehensive breakup of foreign income and corresponding foreign tax country wise and the source wise in the prescribed forms and the prescribed statements. So if we see a small illustration here, here an Indian resident company receives dividend from the wholly owned subsidiary in Singapore, on which Singapore withholding tax has been deducted. So the dividend is taxable in India. However, by filing the prescribed statement and furnishing proof of the tax paid, the Indian company can claim credit for the Singapore tax, you know, subject to the limits and the conditions laid down in rule number 76 and in the India Singapore double taxation avoidance agreement. So this kind of avoids economic double taxation of the same dividend income. So let's proceed to our next concept, which is the transfer pricing framework. And this is I would say the most important concept, and it is governed by section 161 to 173 and rules 77 to 85. So, guys, another critical pillar of international taxation is transfer pricing. The new act retains and reorganizes the transfer pricing provisions to ensure that the profits arising from the international transactions or certain specified domestic transactions between associated enterprises are computed, having regard to the arm's length price. So key statutory provisions includes here section 161 to 165, which defines the terms associated enterprises, international transactions, specified domestic transactions, and of course lay down the mandate to determine income using the arm's length principles. Section 165 here is important, which recognizes different methods such as comparable uncontrolled method or cup method. We normally use resale price method, cost plus method, profit split method, or transactional net margin, which we normally call TNMM method. Apart from this, section 171 and section 172, which require maintenance and keeping and furnishing of the prescribed information and records and documentation and filing of an accountant's report in form, specified form, basically as per the income tax rules. On the rule side, I would say rule 77 to 85 elaborate the operative aspects, how the transfer pricing operates. So they define expressions relevant to the arm's length price, prescribe a detailed computation under each method, and specify documentation requirements and the contents of the accountant's report. So here, if we see the example on this slide, an Indian captive service center pays management fees to its foreign parent, for strategic and administrative services, and also provides back office support to the group entities. So these are international transactions with associated enterprises. The Indian company must maintain documentation, select the most appropriate method, say, let's say TNMM is the most appropriate method here, and demonstrate that the margin it earns in India is in line with the comparable independent entities. And also, it has to be supported by the accountant's report in the prescribed format under the income tax rules. So this is the summarized picture of the transfer pricing provisions. In our upcoming videos, I would say we will definitely go into deeper in all the sections 161 to 173. We'll also discuss all the rules, from section 75 to section 85. I'm planning to record a separate video on specifically the provisions related to transfer pricing framework in our upcoming videos. So let's proceed to our last concept for today, which is concept number 10, the safe harbor rules and the advanced pricing agreements. So basically, guys, to reduce the litigation between the SSC and the department and to give certainty to taxpayers, the law provides two important mechanisms. Number one is safe harbor rules, and number two is advanced pricing agreements, which we normally call APAs. The income tax rules 2026 contain safe harbor rules provisions in rules 86 to rule 103, which specify eligibility conditions and the margin or the pricing that will be accepted as arm's length for certain categories of international transactions and of course specified domestic transactions, including income attribution to business and profession. And also in the income tax rule itself, we have a detailed APA procedures in rules 104 to 120, covering pre-filling, consultation, eligibility, application forms, unilateral, bilateral, multilateral APAs, rollback of APAs to prior years, and of course compliance audit. So correspondingly, the Act recognizes APAs in sections such as 168 and 169, dealing with the authority to enter into APAs, their binding nature, and the effect of such agreements on assessments for the covered year. If you see an example here, a common use case in is an Indian captive IT or the BPO service provider. If it is eligible, it may opt for safe harbor rules for a specific margin to be accepted by the income tax authorities for certain international transactions, thereby minimizing the risk of adjustments. Alternatively, it may enter into a unilateral or bilateral APA with the department to agree on the transfer pricing methodology and the margins for a block of years, with the possibility of rollout to prior years. So both mechanisms are, you know, aiming to bring predictability and to reduce long drawn transfer pricing disputes. And here for this safe harbor rules and APAs, I'm also planning to record a detailed video covering all the concepts in my upcoming videos. So let's quickly recap what we have covered in this first video on international taxation under the new Income Tax Act 2025 and the new Income Tax Rules 2026. So we basically kind of started with the basic idea of international taxation, how residence-based rules and how source-based rules interact when income has cross-border elements. We then discussed the residential status under Section 6, followed by the scope of total income under Section 4 and Section 5. We then, looked at Section 9 on income deemed to accrue or rise in India, including business connection, significant economic presence, indirect transfer rules, etc. And then we examined the special provisions for non-residents and foreign companies in Chapter 13 party, covering the dividends, royalties, interest, FTS, etc. And then we moved to double taxation relief under Section 159, 160, and how the foreign tax credit is operationalized via Rule 75 and 76. And finally, we introduced the transfer pricing framework under Section 161 to 173, with Rule 77 to 85 and certain mechanisms of safe harbor and APS. So this is the coverage of our today's video. In the next video, we will go deeper into the practical treaty interpretation, permanent establishment test, including dependent agent and service fees, attribution of profits, and typical structure seen in India's key double taxation avoidance agreements. Thank you guys. If you found this video useful and helpful, please like, share, and subscribe. And stay tuned for video number 2 in this series, which I'll be taking soon. Thank you.